said I'll come to. So when you look at the stock, and this is for Kenya. We are closing Q3. This is for Kenya. We are closing Q3 this year at 168 billion. But look at the green. 8 billion. But look at the green. If you combine the green, even excluding the FX impact, you're sitting at about 47 billion. So that is the work, that is the strategy paying off, the remediation strategy. But on the other side, you can see there's some significant. Downgrades as well, to the tune of about 48 billion. So make sure that green going forward is a much bigger number than the reds that you have across there. Have we lost a screen? In terms of coverage ratio, marginal decline, especially at the actual provisions for IFRS coverage. But the good news is, when you combine our coverage provisions and the collateral, the value of collateral, which of course we take out a percentage of that value to just ensure that we fit within the IFRS guidelines, we are still above 100. We are still working to get ourselves to the 70 overall target. We had promised that by the end of this year we are looking to close at about 60% coverage ratio, and we've got a quarter to deliver that. Hopefully, I'm still be the same guy standing here in March, telling you that we've hit that 60. I had to throw that one in. Just looking at deposits, remember the deposit number was about 1.5 trillion overall deposit. Of that, 47%, I've lost my trail of thought. The split of that corporate is about 50-50, so almost evenly. And when you look at the key thing on this slide, actually, is if you look at on your right, that thing that looks like a steering wheel, the contribution of term and call, same period last year combined, was 27%. This year, that has gone up to 33%, which means we are paying for more of our deposits. So our franchise for the cheaper deposits, or quote-unquote free deposits, has actually shrunk. Now combine that with the fact that the interest rates, as Paul presented earlier, has gone very high, has really contributed to a massive increase in our cost of funding, especially impacting the Kenya-based banks, which is KCB Kenya and NBK. Coming to the income statement side, our revenues grew 22% to close at 143 billion. You can see contribution coming out of interest income, 27%. That was largely driven by volume and rates, as we needed to increase rates to offset the large 47% you're seeing on the interest expense side. Deposits, just from deposits, as customer deposits, interest expense went up by 47%. So to match that with the risk-based pricing, we needed to increase our rates. I'll also single out government securities, 27% growth. And that's not because we invested more in government paper, but the government paper that we actually attracted us was yielding much better in the period under review. FX income as well had a very good nine months, 68% growth. Largely driven by the Kenya business, so Peter and your team, and also have come in quite strong in terms of delivery of the FX income to the group. Coming to cost, I'm very happy that the cost slide this year is very simple. I don't have to explain like for like and that sort of stuff. An 11% growth on costs to close at 60. Lost now this one. 24% funded income. Prudent cost management. Would want to limit cost increase to a single digit. We are at 11%, but we are, planning to get back to single digit. But nonetheless, in the environment we are in, I think that has contributed greatly in delivering a full 9 months profit after tax of the 45.8 billion. When you look at how that was cut across from our subsidiaries, 37% of it is coming out of subsidiaries outside of KCB Kenya. And if you look at the year-on-year change on the right-hand side, you can see very good double-digit growth. KCB Kenya 32, TMB 47, South Sudan 172. Roba, well done. Yeah. So the only outlier there is KCB Tanzania at PAT level, and that's because last year they had a one-off gain on tax that it dropped their tax rate. When I look at KCB Tanzania from a PBT point of view, they've had a 34% year-on-year growth. So it's not that they've been left. That has translated into very good return on equity, 25.6 at group level. But look at across all the subsidiaries. All are in double digits. I would want to say gone are the days when we used to have single digit contributors. The only good single digit should be somebody's handicap. But a fantastic evolution on ROE. And to our two shareholders here, you used to bash us a lot on this slide. Why do we put money outside of Kenya where we can invest it in Kenya? This, I think, is answers those questions. We diversify our revenue streams. We diversify our sources of income geographically, because when one bank, one country is limping, the others come to support us. And then finally, on our scorecard, we have changed some of what we had shared earlier on. Those who are keen will notice something like NPL. We've marginally moved that on the range. We are currently sitting at 18.5. The recovery team has told me that they are working very hard to bring that 18.5 to within the range in this remaining quarter. We shall hold them to account. Cost of funds is an outlier as well, sitting at 4.2. We had initially anticipated it will be between 3.3 and 3.6. We had even budgeted with a lower number of 3.1 for group, because we did not expect that the interest rates will be where they are. That has gone up to between 4 and 4.5 and 4.4. We've also changed the asset yields, marginally moved it up because of, especially on investment in government security, the yields we are getting from that, and also the risk-based pricing that we talked to earlier. So I will stop there and take questions from here. Thank you very much.
Thank you so much. Another round of applause to our Group CEO, Paul Russo, and our Group Finance Director, that is Lawrence Kimathi. Now, we are going to get into the Q&A session. I don't know, Sam, if we are supposed to have this on the podium, but in the meantime, excellent. So we're going to have questions, Algline users and the ones and the team that's on the floor. Please, once you have your mic, introduce yourself, from which industry you're from, and the question. Okay, great. But in the meantime, let me pick some questions that I've just received. Okay, maybe as we're having that, do you have any questions on the floor? Anybody? Yes. Yes, we are going digital, Lawrence. Thank you. Thank you, Anastasia, for saving us on that. We were being asked, so where are the writing pads? But in the spirit of sustainability, we are not entertaining papers on the podium. Thank you. Do we have any questions? If there are no questions, allow me to take one, at least two. To our group CEO, as you get to the podium. This is the only time I get to.
It is 47%. KCB's liquidity is 47%. And I always say the best way to test is, because the branch is closed, if you have money on, you have KCB app, you go move money from your bank to M-Pesa, and then we see if there is a limit. And then move back after you've done. Yeah, please move back. Yeah, just test and then move back, right? So there is no other answer that I can give. We don't limit, but today I can say you've seen the liquidity is 47%. You can try. You want to try and that you can, and then return. Yeah.
Yes, I will, sir. And I hope the person who asked that question, they can actually confirm that. But that's a true position. Thank you so much for that clarification, the group CEO. Then we go to our group director of finance. There's a question. Interest rates remain high despite the inflation rates stabilizing. How do you explain this disparity? And if there's any question on the floor, please let us know.
So let me, I'm trying to find, I'm laughing because this question actually came earlier in another meeting we were in today. So the way the risk-based pricing works is, yes, inflation has a link because that's what, the monetary policy is used to try and control. So if they increase the rates, basically they're trying to suck out money from the economy because inflation is high, and if they cut, it's the other way. However, our risk-based pricing framework, what was approved, carries a lot more than just the CBR rate, which is what the regulator uses for monitoring or managing inflation. There is the cost of money, cost of funds, which we've talked about, where the rates, the interest rate, risk-free rates are 91-day bill, 365, 5-year bonds, because you have to look at what the term of in your book of government securities that are sitting in your book. What is the average tenure, and then you come up with what the rate would be from there. That then gets you to, and of course, return to the shareholders, because shareholders have invested for a return. So that gets you your base rate. So a lot of items in there need to actually move. The biggest one that needs to drive the rate down is the risk rate in the market.
Excellent. Thank you. Thank you so much. Do we have any question? Okay. Kindly, Sam, if you can help me move the mic to the gentleman. Remember to introduce yourself from the organization and the question. Thank you.
Hi, my name is Brian Jodotino from NTV Business. I have two questions now that one has already been sorted out. Number one is that we recently had a roundtable with the CS for Treasury, CS John Buddy. He mentioned that government needs, or rather intends, to exit the debt market, the domestic debt market particularly. And this has been constituted by government paper, the bonds, the T-bills and the like. And that potentially would drive down the yields on such papers. So what does this portend for KCB as a bank in terms of looking at alternatives for funding, and also would this potentially free up more resources to fund to MSMEs, as CEO Paul Russo had mentioned earlier? And then lastly is the inflation rate, which is currently at 2.7%. We are on tipping point towards the baseline, which is 2.5%. That would see us going to a deceleration. This is not necessarily an in-house issue. This is a macroeconomic issue. How are you preparing for a potential deceleration if that comes to pass? Because we are looking at the biggest drivers of inflation are still food prices. So how is the bank preparing for that? Thank you. Those are my two questions.
So I'm not sure. I think whether it is, on your first question, whether if they exit, that will bank funding. In fact, they should release a lot more. I think it will start answering the question on how we get to lend more to the private sector, right? So for Kenyans and for banks that have good intention for the country, for lack of a better word, I think for me is the opportunity. Because like what Laura said, if free risk rate, because there's no free, but if free remains at that level and it's consistent, isn't it, in the market, two things will happen, right? It's not just banks, because I think people focus on banks. Customers are putting money in those instruments. You saw your sister publication today. Churches, individuals have overtaken banks in that investment. You see, we read your paper, isn't it? So if they continue to do that, just keep banks for a while aside, it just means that banks have to pay higher rates, isn't it, to be able to meet the demand from the customers. And that just causes us, because it's risk-based pricing model, you then have to price that element, isn't it? Therefore, it becomes a lot difficult for the private sector to borrow. So I think, my personal considered view, it is welcome, right? For banks, it's welcome. We've got demand. You've seen the demand from the female-led and managed enterprises. We've got demand. And at the end of the day, but we've got to get deposits at a lower rate. And you see, you're the same depositors. Journalists sometimes they ask questions and they write like they're not in this. You're depositors, isn't it? Now, there are customers who are locking for long term. They know rates will come down, isn't it? And that's exactly why we are not turning the effect on pricing faster, because those deposits, it's 3 to 6 months, some of them 12 months. So there is a lag. And I think if I was to extend it a little bit, so we were used to pre-risk-based pricing, isn't it? CBK lowers CBR rate, there is a direct, isn't it? We follow, isn't it? In risk-based pricing, you have to go in and adjust those factors, right? So there's a lag in the current model, and that's why you see people complaining, because we've moved to risk-based pricing. But I think, in my view, people are still waiting for that immediate adjustment that was there before risk-based pricing. And we all run completely different models. Principles are the same, but it depends on your customer profile, on your liquidity base, right? And your cost of funds, they differ from bank to bank. So a long way to answer you, but I think it's always better to answer broadly for everyone else. It's favorable. That's the hard thing. So a customer who has worked hard and has harvested maize, maybe we'll place it in a place that gives a higher rate of return. As basic as it is for us, because we have customers listening to us. And we really as KCB want to be at the forefront to lower interest rates. And as Lawrence said, we must work on the elements. And it's a collective. It's not a CBK problem. It's not a treasury problem. It's not a bank's problem. It's a collective.
Yeah, Brian, let me attempt to comment, maybe not answer your second question, because as you said, it's not for here. It's a very interesting question. 2.7% inflation. There's an upcoming MPC, I think 5th or 6th of December. There's pressure to reduce interest to banks. If I remember my economics 101, if you reduce interest, it means you're pushing more money into the economy. You're encouraging people to borrow. Is the plan to get the inflation up? Because then you have a lot more money in the circulating in the economy. Ideally, that should take the inflation up. So that's one route. I don't know whether that's a route that the regulator is looking at. But I'm very, very keen to see the decision he'll make when it comes, or rather the MPC will make, because it's a committee, come in the next 2 weeks. Just sticking on inflation, the perception to most people, even here, is much as it's 2.75, it's been hit. You have less because of the fiscal policy that has been implemented. You're not really feeling as though you can afford more. And also the way inflation works, it's the rate of price increase that has come down. It's not that things have gotten cheaper. So, you had a price increase of 100 shillings last year, which equated to 10%. This year, it has gone up by 20 shillings, which is, maybe 2%. But from 2 years ago, it means you are paying 120 shillings more. Yeah, so it's not that things have gotten cheaper. It is just the price, the rate of escalation of the price that has come down. So let's wait and see how that will be answered on 6th of December.
Excellent. Thank you so much, Lawrence, and thank you so much, Paul. You want to go for the last question? Comment. Okay. If you can have mic to one of our very key shareholder. Asante, please introduce yourself, and then that's the last comment, and we'll close the session. Thank you.
Thank you. Today I'm going to sing you a song, but before I do that, I'm very excited to be here. My name is Sally Jepkorir, a very passionate shareholder of several other companies, including the KCB, which I loved so much. So I want to say to managing directors, the board of directors, the management, the staff, the members of the Fourth Estate, and my fellow shareholder here. I want to say this to the board of directors, that thank you for giving this company a touch of quality and a taste of excellence. Munipikie makofi hapo. So shareholder, we are really proud of you for working tirelessly so that we can create good dividends. You told us to wait. It was a long wait, but finally we received interim dividends that was so huge. And we love you guys so much for that work. And by so doing, I'm going to sing. KCB songa, songa nasi tusonge, benki yetu iendelee mbele, naruso 20, songa nasi iendelee mbele. Nataka sasa sisi wote tuimbe hivyo. KCB songa, songa nasi tusonge, benki yetu iendelee mbele, wakurugenzi wote tusonge mbele, songa nasi tusonge, benki yetu iendelee mbele, na wanaisa wote.
And I'd like to take this opportunity to request our group CEO, our group finance director, to come off the stage and really to thank you for always leading us to a touch of quality and a taste of excellence. Much. Asante sana. And as the leadership is having their seat, it's just to say we mark the end of our program this particular evening, but we have our press releases on circulation. For, Peter Maura, if in case you need the press release, kindly see Peter Maura. And I believe we also have assigned or designated media interviews, and Peter will also be coordinating that. Over and above that, we have our head of investor relations, who is also be coordinating an investor session and will be reaching out to you. Mine is to say thank you so much to all our online users who joined us this evening. A fantastic day ahead, or should I